Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Joining me today, my good friend, special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She is a tax expert for individuals and small business owners, and we're going to be talking about retirement income. So there are three categories of retirement income when it comes to taxes as well. We have the taxable, we have the tax deferred, and the tax-free.
I like the third one.
Yeah, tax-free is good. Tax-deferred is good. Tax-free is even better.
Exactly. Taxable's the West.
And when you get into these, you look at, understanding what fits into those different categories. So if you look at the taxable sources of retirement income, okay, there you go. The type of income, for instance, investment sales or earnings, stocks, most bonds, taxable portion of your Social Security income, and profit from selling real estate. So these are different types of income. But now how the tax works on those, Friday, you can...
Right. So investment sales or earnings, stocks, bonds, that's usually capital gains depending if it's held for a year plus 1 day, or it's ordinary income if it has only been held for a few months or less than a year. So that one can have either or, obviously. The taxable portion of your Social Security is ordinary income, and they can tax up to 85% of what you receive. And again, that's based on the what's called provisional income tax code. And then we have the profit from sale of real estate, which this one is really important this year. I think I've done more home sales. So if it's your primary home, in most cases it's capital gains, or in this certain circumstance, let's say you have a home and you purchased it 5 years ago for $100,000, and today you're selling it for $300,000, and you're single. We have what's called an exclusion of $250,000 for an individual, $500,000 for married. So you would take that basis, the original purchase price, add the $250 or $500, and then whatever that is against what you sell it for is what the difference would be. Now, I've had quite a few people this year that have actually sold their primary homes, and they've actually bypassed or went past the exclusion. So in that same scenario, you purchased it for $100, but you sold it for $400, and you're single. Well, you'd only have $300,000 or $350,000 for the exclusion. So that other $50,000 would be long-term capital gains, and so that's what you really need to calculate. We've had quite a few of them, Hank, this year that people have purchased and sold
we just talked that one, even with a couple. So understanding, again, what Friday just said there, you got $250,000 exemption from capital gains taxes for an individual, and then double that for a couple to $500,000. So what that means is whatever you bought the house for, that's your cost basis.
Right.
Okay, now maybe you invested some money into it.
Maybe some improvements. You redid the kitchen, you redid the patio, something you may be able to add. But the basis, what you originally paid plus major improvements. Now, let me clarify that, because sometimes people will say, well, I painted the house a few years ago, or I put a roof on it a few years ago. Well, if it was 7 or 8 years, you may not have really increased the profit of that home. So you really needs to be what increased the value. You redid the kitchen, would have increased the value. But maybe painting some walls may not have really increased the value. So you have to be careful of what you might consider increasing the value. Yeah,
renovations, updating, new appliances, things that, are going to stay with the home, or like a new kitchen, as Friday's saying, things that improve the value you can add to your cost basis. Now, as in her example, she said $100,000. You bought something for $100,000, you sold it for $400,000, you have a $300,000 gain. Now the $250 exemption reduces down that gain. You don't have to pay tax on it. That leaves $300,000 from $250, leaves you $50,000 in taxable gain. And then depending on your what your income is. So if a couple, let's say you had a $50,000 gain, but your income that year, maybe all you had was Social Security coming in. And now you've got a $50,000 gain, right? But the two together, all your income together is still under that approximately 112 for this year. Zero tax. So capital gains rates, this is one of the big benefits if you're in those lower brackets, is potentially no tax at all. Now, Friday, the tax on the other hand, though, if you go over that 100,000 and the gain counts, and could push you over, but now you're going to have a tax.
Then you're going to be looking at 15, but let's say you're a married couple that makes more than $250,000, and now you've got that $50,000. Now you're going to be at 18.8. And then again, it can go above that on the next one. But it's really important. And I do want to reiterate, the tax law today is you have a $250,000 for a single, $500,000 for a married. You do not have to reinvest. There is no 24-month reinvestment. You cannot defer into another home the profits from this home. You either meet the exclusion or you don't. Buying another home will not eliminate the taxes on the sale of your home if you have some.
And this is the chart, the slide we're showing you right now.
Good job, Mary.
Capital gains, again, with the increase, as we just illustrated, between your what you paid for something and what you sold it for. Now, if you held it for less than a year, that's short-term gains. Now, they're still taxed at ordinary income tax rates.
Right.
You're not going to get a break on those. But long-term gains, again, 1 year and 1 day that you held it before you sold it, that's where, as Friday was just going over with you, and the graph shows, if, you know, depending on your bracket as to what you're going to pay in tax. If you're in that 22 or higher, it's 15. If you get in the the top bracket, it'll go up to 20%. And then Friday, there's also that excise tax, right?
I want to jump in because there is the Medicare tax that they have, which is a 3.8 tax. So whenever people go into capital gains, they do quote the 0, 15, and 20. But keep in mind that most people that hit the 15% that are over 250,000, anything above that is going to get the Medicare tax of 3.8. So if that 50,000 kicks you over, you could actually be at 18.8. And we have the same thing on the 20%. So when you get over the, 256 or thereabouts on a single person, then you might be at 20 plus the 3.8. That 3.8 kicks in after the 250,000 for individuals or whatever. So it can be a bit higher. So you definitely want to talk to a tax person to make sure, because if you set aside 20 and it's now almost 24%, it's not going to be a good tax day for you.
That's it. Yeah, especially if you have a really, we've had
large capital gains
that are
lately.
Selling, that are coming around with, $500,000 or more in capital gains, and you're going to get hit with some pretty good taxes. But also understanding the way the system works, as we just said, if you're in the 10 or 12% bracket, you got zero tax. When this is a little different from the progressive nature we were talking about earlier, right? On the progressive side of taxes, if you cross into the 22% bracket, only the dollars that went over are taxed at 22. Capital gains work differently, though. If you cross that threshold, everything in the capital gain then is taxed at 15. But Friday, we're talking about the Medicare tax or the excise tax.
Right, now that one is progressive again, because they're going to only take what exceeds those markers if it's single or married, and then they're going to start multiplying that by the 3.8 for the additional tax. And it does show up on a different line on your tax return. But it's always surprising when you see $7,000 or $8,000 additional dollars, and everyone's like, well, I thought it was 15. And remember, on the home exclusion, you do have to live in that home 2 out of the last 5 years. It doesn't have to be consecutive, so you may have moved out and then moved back in, but it has to be 2 out of 5 years that you were living in that home to be able to qualify for the home exclusion.
So these are, again, that's a lot of,
that's a lot of information.
Not looking to educate you to the point of you're remembering all these things, but just to illustrate to you how complex the tax code can be and all the different rules that go there, and how you can easily pay more in tax simply from not knowing those rules. So make sure you've got someone that's really good working with you, ideally a team effort where you've got your financial advisor, your tax advisor, estate planning comes to mind as well as another one that ties in there, that they're all working together to do the best plan for you. And this goes back to what we were saying about, Friday and I each year are running numbers for clients based on Roth conversions for one. And there are others that will run as well, just like the gentleman I mentioned earlier, whether to take that RMD this year, right, in his first year, or postpone it. And as a married couple, sometimes we, in particular, if maybe both are taking RMDs at the same time, we also have some flexibility to where we can have one maybe take this year and the other one take next year, twice. Another way, there's a lot of ways that you can basically work around these things to minimize your taxes. Again, you get the choice, It's yours to do, and we're going to run the numbers to see which choice gets you the best result.
Right.
And like I said, Friday and I work together each year with clients, helping them with those kind of choices, as well as, you know, I mentioned Roth conversions, other things we do from a income standpoint where we're trying to reduce taxes and employ different strategies
Absolutely.
to do that. In fact, I'm going to, you know, one more time, if you'd like to get that type of planning for yourself or have a second set of eyes, look over, you know, how your plan is going today, just call my office at 615-376-5325, and we can help you with that. We can help you minimize your taxes, again, over the long term. This is most important. You know, sometimes, as I mentioned, with Roth conversions, we might do a conversion where we're paying tax on that money today, where we could defer it into the future, right? But if in the future we're going to end up paying even more tax, why would we do that? I mentioned a gentleman again about the RMD as an example. We're going to save him $4,000 on his taxes just by how we take his RMD. Okay, so there are ways that you can follow the rules, and it's just understanding the rules that you get choices within the rules, and those choices can help you reduce your taxes. All right, so again, 615-376-5325. If you'd like to get the whole comprehensive plan, show your financial future based on what you're doing today, and then share with you strategies to help you make that an even bigger, brighter, better future. All right, so call the office, 615-376-5325. And when you call in, we'll get your information, send you out a checklist of things to bring to your appointment with me to do this planning for you. And when you come in to see me again, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, we were talking about these different types of income.
Right.
Now we're going to talk about tax-deferred sources of retirement income. Excuse me. So
That's actually a little simpler, because most of them are going to fall back into your ordinary, right? We have pensions, which at some point you work for someone. Don't have a lot of pensions nowadays. Less pensions being offered, I think, than there used to be. Retirement savings are huge, right? Your 401ks, your 403bs, your 457s, your traditional IRAs, and then annuities. Each one of these categories, even though they're saved maybe in different ways, when they come out, they're still going to come out as ordinary income. So that's kind of the important, because the interest growing, and I know Hank has always had some pretty interesting planning where, you know, if a stock, and you can pay long-term capital gains, he'll put in one type of category versus interest or dividends that can grow at ordinary income no matter what. So why not pay it as ordinary growing? And that's a way to manage. I think that's always cool,
we're always
the way you've
looking
done
for
that.
ways. And it's understanding ordinary income tax versus capital gains, and then how you can use that to your advantage.
Right.
We're going to take another break, and we're going to use you a couple more examples of how you can use that, and understanding the importance of your investments in your retirement accounts as well as monies outside of those retirement accounts. But first, a break. Join us here. We'll be right back on the Retirement Report.